Well, welcome to the 2020 Illinois Farm Economics Summits. I'm your moderator, Todd Gleason. This is the second in a series of 5. We appreciate you being here for the day. A couple of panelists will be with us for the program, and they will make presentations on the 2020 and 2021 grain farm income outlook with risk and rental implications. Dale Latz is here along with Gary Schnicke. Thank you, gentlemen, for being with us for the day. We appreciate you taking your time. We do have a poll this morning to get us started. I'd like to have Gary pull this one up. And Gary would like to know, are you optimistic about grain farm incomes in 2021? Here's the question. I believe incomes will be above the 2013-2020 average. Close to the 2013-2020 average, below the 2013-2020 average. So go ahead
and by the way, that's next year. So
yep. So that's for next year, not for this year. So go ahead and fill that in. We're getting started here. We've got about 380 on. We'll get a lot more than that, I would think, as we get started. But as we take off here in the first couple of minutes, people are still jumping on. Go ahead and fill that poll out, and we'll put ourselves, 72% have voted at this point, so we may as well move along with this question. There we go. The answers to the question are that 36% of you say they'll be above the 2013-2020 average, and 56% say it'll be close to that average. Just 8% think we'll be well below that average of 2013 to 2020. So that's a look forward into the 2021 grain farm income outlook. And to discuss that more thoroughly, we have both Gary Schnicke and Dale Latz with us. Good morning, gentlemen. I don't know which of the two of you are going to begin today.
Well, we're gonna trade off here quite a bit. So this is Gary Schnicke, and I'm going to start us out. Then Dale Latz will jump on in, and Dale's here, so let's get going. What we're going to do is cover 3 topics today. We're going to go over income outlook. So we're going to talk about what we believe 2020 and 2021 have as far as outlook. We're going to then look at risk, some of the risk implications, and then finally talk about some of the implications of that for rental arrangements. So that's our outline for today. All right, so first we're going to talk about yields, and Dale, take it away.
Yeah, good morning, everyone. Pleasure to be here with you. And as Gary said, Gary and I will kind of go back and forth on the presentation in the next 30 minutes or so. I've got a couple slides here as we talk about the first part of the presentation being income outlook. Of course, in Illinois, we mainly, a big driver of that's with a large amount of corn and soybean production in the state. Our part of that then is the yields for those 2 major crops grown in Illinois corn yields and Illinois soybean yields. The graph chart that's up on the screen right now shows the Illinois corn yields from 1970 through 2020 projected for the current year. Illinois Ag Statistics have been putting out for the last couple of months average yields. We don't have a final estimate yet, but we don't expect a lot of variation probably from this figure that shows up on the screen. So right now we're looking at an average yield, corn yield in Illinois of 195 bushel per acre. As you look at that graph, you can see the orange line are the actual figures for each of the years going back to 1970. The black line is the trend yield. And I believe, Gary, what trends usually about 2.5 bushel increase per year, something
closer
like
to
that.
Closer to 2 bushels a year, yes, typically in Illinois.
Increase on the trend if you go back over time. So we're looking at about a 4 bushel average above trend. So a very good production year again in Illinois, not breaking any records, but a good year. The bottom part of that chart shows the deviation from trend. And so that's bushel per acre. If it's black positive or above that line, that's the bushel per acre above trend. Below that would be the actual figure below trend for that given year. And you can see if we go back 20 years or so, there's only about 5 years out of the 20 years that actually have been below trend. The largest below trend year goes back to 2012 when we had weather issues and obviously a large amount below trend there. Last year we were below trend a little bit, 8 bushels per acre. This year, as I mentioned, 4 bushel per acre above. So again, not the record-breaking yields that we've had some of the last 5 or 6 years, but again, generally a good year for corn production in the state. If we kind of go on to the next slide, which shows soybean yields, again, going back to 1970, we can see the black line is the trend. And Gary, I believe that's about, what, a half a bushel increase per year on
Yep.
soy.
Yep, that's correct, Jim.
Okay. So you can see in the projection right now for 2020 for the corn yield for Illinois is at 58 bushel per acre. That's 2 bushel per acre above trend and above from the previous year, which was 1 bushel per acre below trend. Again, if you look at the last number of years, we had 5 years in a row there where we were significantly above trend, as we've seen kind of the increase in soybean production across the state taking effect. This year, again, a decent year, but not anywhere near the yields we've had in past years. Much of Illinois was dry in August, as a lot of the Midwest, and that did probably especially hurt soybean yields compared to corn yields, and that did show in the figure in the average results. But even given that, we still were above trend a little bit. So another good year, not the great years like we've had, but a decent year in terms of production. Again, you can go back and see the trends over the past 20 years or so. And again, back to pretty close to trend with that dry August. So again, as we talk about both corn and soybean yields, a decent year, not record-breaking per se, but in many areas of the state, we've had very decent yields for both corn and soybean production, which is going to put a base for good farm incomes as we look at 2020 farm incomes.
So,
Okay, go ahead, Gary.
so as we look at our expectations that we saw this year, we've obviously had some pretty wide swings in what we believe yields and prices we're going to look like for 2020. And some of the things, again, as Dale mentioned, late in the season that impacted our news was the hot, dry August and the Draco storm in Iowa. And as you can see here, that we're showing the drought monitor map for September 8, 2020. A lot of Iowa and Illinois and Indiana, for that matter, were droughty and dry. And again, that Draco storm had pretty large impacts. That very much changed what we were looking at for yields across the United States. If we were, and this is our August estimates here, not our August estimates, but the USDA's estimates, and they were looking at a 202 bushel yield for Iowa in August, and the last one we have, November, 184 bushels per acre. Obviously, that has a big impact then on yields across the United States. 181.8 was the estimate in August, and now we're looking at 175.8 bushels. And again, that was to some extent that fall in Iowa. Iowa is the largest corn-producing state in the nation. Illinois came down as well, but a number of states came down as well. But we're now looking at something closer to yield of 175.8. As a result of that and continued good export demand, actually, as we learned on Tuesday, our 2020 market year average price has increased, or what we were looking at, and $3.10 was what we were looking at in August. Now we're looking at something at $4 for November. Again, this is the outlook for the 2020 market year average price. That will be set from September to August, and as you can see, that went up considerably, $3.10 to $4. Everything works better with $4 corn. That also implies that if you're looking at that $4 corn price and what we might be looking for ARC PLC payments, if you signed up for a PLC, that would not generate a PLC payment, and there will be generally very small ARC payments in general for 2020. That would be the projections right now. Soybeans, sort of the same phenomena, 58, 54 now. Again, hot, dry August, 53. That was Iowa. Again, focusing a bit on Iowa. Yields across the United States went from 53.3 to 50.7. Market year average price estimates in August, 835. We were not very optimistic then. Again, that's a USDA forecast now, and now we're looking at 1040. Obviously, you increase the soybean price that amount. That's over that's $2 a bushel. You're gonna and corn prices went up 90 cents according to USDA, or estimates of those are. That's going to have a very dramatic impact on income estimates. Again, we had this roller coaster year. This is showing our harvest time futures contract for December 2020 and November 2020 soybeans. We were running for corn something before, in the previous year, something in the 4 to 420 range, and that began coming down. We had our COVID-19 control measures happening right in here, and we hit lows. Again, this is a futures contract in the 320 to 340 range, and then since August that has gone up. Again, news of the dry weather news played into that, as well as continue our growing demand primarily from China for exports. And again, we saw those corn prices at the end of the contract in the $4 range for corn, and the $10 range for high $10 range for soybeans. Again, that just gives you a feel for the roller coaster year that has. We were thinking that COVID-19 control measures would have a large negative impact on incomes. And as it turns out, those incomes might be, from a price standpoint, be near the levels they were projected to be before COVID-19 control measures. And there's where we're at. Along with that, we had additional federal aid this year, and Dale, take away that discussion.
Yeah, so we've kind of covered, obviously the basics on incomes in regards to corn and soybean yields and corn and soybean prices, and what a difference 4 or 5 months makes. Or a year ago, I'm sure when we were looking at 2020 incomes, we probably weren't very optimistic, and even 6 months ago. But along with the increase in prices due to some supply issues, but mainly strong export of both corn and beans, with China being a big factor in there. As far as effects on farm income, obviously for 2020 is the additional farm program, different types of program payments, farm aid payments, whatever you want to call them. And you can see this slide shows some of the different types of programs we had this year. WIP Plus for 18 and 19 years, some of that being paid out now. The Paycheck Protection Program, the PPP loans, many farmers did take advantage of that. A large percentage of those loans, a large percentage of those dollars will most likely be forgiven on those notes, as if they're used for eligible farm expenses. And so we're kind of right in the middle of that process right now of going through and doing the paperwork for forgiving those loans. Just since that's kind of based on the farm business, we're kind of throwing that into the farm income here as far as adding to income. We also had idle loans, economic injury disaster loans, were grants that some farmers took out, $1,000 grants per employee, something like that. And then some of the bigger things, of course, the additional CFAP and MFP payments on the 2020 crop, along with some finishing up of 2019. So we had MFP payments earlier this year. We had CFAP 1 and CFAP 2. It's kind of hard to keep track of all those things besides some of the WIP Plus that were still coming in. So obviously a lot of that is this year is added to farm incomes and supported farm incomes from a standpoint that we thought maybe was going to be a tough year. It's going to turn out to be maybe one of the better years in the last 3 or 4 years anyway. As we move to the next slide, Gary, we'll try to put some numbers to all that discussion here. So this shows 2018 and 19 farm income and expenses. This would be Central Illinois higher productivity soils. You can see the actual yields on these farms for 18 and 19, kind of prices that were received for both corn and soybeans. You can see in the 360 area for corn and the $9 and $8.60 area for soybeans. As we talk about revenue then, you can see the yellow shaded areas are some of the MFP and CFAP payments that we're estimating on average that farmers would have received for corn and soybeans. A couple things here that's really important to point out is we are kind of estimating averages on these. We are assigning the income to the year it was kind of earned or paid for. So we realized there were some MFP payments that were paid in 2020 and some CFAP 1 payments paid on inventory paid in 2020, but really kind of was accrued to the 2019 crop. So we're trying to assign that income to the years that they were paid for, if you can understand that. Same thing with the ARC PLC. We just had some ARC PLC payments that were paid here in October, but that was for the 2019 crop year. So we were kind of assigning those to the 2019 crop year, even though they were paid in 2020. So kind of keep that in mind as you look at these numbers, because it's going to be a little different in when a farmer may have actually received these payments compared to how we're trying to show these in our income and expense figures on this table we're showing. Gary, if we move along here and hit that, I think we can bring in the 2020 figures. Again, we're kind of estimating yields here on these farms. Again, this is an estimate of 228 bushel per acre. Again, Central Illinois highest soil productivity. Using at this point kind of an average of $3.90. And, that's going to be kind of a hard one, both corn and soybean price to see, because if a lot of farmers sell part of their crop ahead of time, and so part of the crop's going to be sold at maybe $3.40, $3.60, and now we're over $4. So depending on your marketing on individual farms is going to affect the bottom line quite a bit. Kind of moving ahead there, Gary. Let's see what else we got. For soybeans, estimating an average of 70 bushel per acre at $10.40. Again, we had prices in the $8 range, maybe early in the spring and early summer, that we might have sold some for, and kind of kept moving through that to the 9s and the 10s. And I'm sure probably more soybeans than corn as far as a percentage of what's been sold ahead at those prices. When we were thinking we might get $8.50 and it hit $9.50, sure, we were kind of moving some grain along here. The market was asking for it and prices kept moving up, and we had a $3 run up in prices. So again, marketing is going to have an impact on that. Let's kind of fill in the rest of that table, Gary, and see where we're at the bottom line. Again, showing CFAP estimated payments for kind of CFAP 2, if you will, for 2020 there, kind of assigning it to this corn and soybean base and how they were paid. You can see an estimate gross revenue of about $937 for corn for 2020. Again, these are projections, $745 for beans. Subtracting off non-land costs, we're getting kind of an operator and land return, so that would be without a land charge yet, of $366 per acre for corn, $386 for soybeans. We've seen kind of cash rents more or less stable the last 3 or 4 years. We're just plugging in an average of $275. So subtracting that back off, you'd have a farmer return of $91 per acre for corn and $111 for soybeans. Generally, that's going to be quite a bit higher than what we've been at. If we look in the past number of years, we did have a high year for soybeans in 2018 with a large MFP payment. But again, higher than what we would thought of 6 months ago or a year ago, which is a good thing. At the bottom of the table, though, you can see the difference. If we have what that average, that's a blend of the corn and soybean returns for 2020, for example, of $101 per acre. That's an average of the two crops with the ad hoc federal payments. If we take those payments back out, you can see we're down to $23 an acre. So again, a significant part of the farm income for 2020, especially, and 2019, are some of the ad hoc farm payments that we've had in the last year and a half or so. So again, higher than what we expected. Another thing that's kind of interesting here, we do see differences generally I think we've said, and Gary will look at that here in a few slides, that soybeans maybe have been a little more profitable than corn. Here, the last 2 years, 19 and projections for 20, we see them pretty close to each other, at least in the central part of the state with those yields and the prices we're using. So both positive figures that are good. So again, if looking at this today compared to what we thought 6 months ago, a year ago, a lot higher returns than what we expected. Again, good yields, price increases based on low supply issues and strong exports, and then throw in on top of that the additional ad hoc federal payments, CFAP and MFP, all boosted the revenues compared to what we thought of. Gary?
Yeah, and just a note here, this CFAP 31 and 14 for 2019 were actually received in the first part of this year. So that gives you, so we're assigning that to the 2019 crop because that was associated with the 2019 crop. What happens on incomes will depend a lot on when you recognize that CFAP payment. We asked the question here, any insight on ARC IC payments? Most of the 2019 payments have been made, so you should have received those. The ones where there have been holdups that are ARC IC payments, I've heard of a number of cases where those are being paid, so hopefully everybody will get those payments here shortly. We're going to now move on to the 2021 budgets. And here we're going to give you two scenarios, a baseline, and what we're going to be using here, we're going to show those same things for 2020. We're going to do 2021. We're going to start with trend yields, which is 217 bushel per acre corn, 68 bushel per acre soybeans, no ad hoc payments, and current fall bids. Then we're going to go an optimistic scenario because we always get high yields. We're going to get above trend yields, no lowering of price, which may be a poor assumption, and a $25 additional ad hoc disaster payments. Right now, though, we want to know. Let me get the poll going here. What do you expect fall delivery prices for corn to be in 2021? Before we tell you what we think, we want to ask you what you all think. So here's your opportunity to give. Corn prices and soybean prices are going to have a pretty key impact on what these values look like. 82% of you believe that price is going to be between $3.50 and $4. 13% of you are more optimistic at $13 or above $4, and 5% of you are below $3.50, and none of you are all that pessimistic and believe we're below $3. All right, we're going to go through and show you our budgets. Here's our 2020, and now let's put 2021 in here. 217 bushels per acre on corn, 370 corn price, and that comes up with $830 of revenue. So we're sort of where everyone else is, 370. Actually, if you look at fall deliveries today for 2021, that might be a little bit low. We're looking, you could contract for 380, but we're right in that below $3.50 to $4 range. That price would not generate any ARC PLC payments, and that would be the payment that's not received in 2021, but in 2022, and we have no MFP or CFAP payments here as well. We upped non-land cost from $571 to $580, largely because of seed price increase or projected seed price increases and some fertilizer price increases, and we are holding cash rents at the same level. That scenario results in a minus $52 farmer return for corn in 2021. Moving on to soybeans, we got a 68 bushel yield here. That's would be our baseline. We've sort of increased our soybean yields over time, or increased the trend yield, because we've seen that increase quite a lot. We're putting in a $9.80 price. Again, that's close to fall delivery. That's still, from my standpoint, a pretty good price. $3.80 coming up with $666 of revenue. And again, we put no those wouldn't generate ARC PLC payments, MFP payments, or we're not putting any MFP or CFAP payments in here. $360 of non-line cost, $275 of cash rent. We have a $31 projected return. Again, this is our base scenario, and that would result in a minus $11 return. Again, that was that is below what we had in 2018, 2019, and 2020. All right, let's move on to the optimistic scenario. Again, as we have been doing for years now, if you use base trend yield projections, prices at fall delivery, and no ad hoc federal payments, you get very low returns. So that's what we would be looking at for 2021. Let's be a little bit more optimistic here, and I'm going to put in here a 230 bushel yield. So we're going to go back and sort of have a good year yield again. We did not change price at all. Again, that may be typically when we see above trend yields, we would see lower prices. $25 of CFAP, and we get to $33 of farmer return on corn. Do the same thing for soybeans, raise this to $76 per acre, and that would give us a farmer return of $55 with ad hoc payments, $30 without ad hoc payments. Again, if we have above trend yields like we had and these prices, $30 return without ad hoc federal payments, that would put us right at something like a 2019 income projection. And we'll make sure you see that 2019, what actually happened in 2019. That would put us pretty close to that 2019 income projection. If we get to $55, that would be roughly half of what we're saying for 2018 and 2020. 2018 would probably be the better one to look at, because we're going to have in 2020 some PPP and idle payments in there as well. So given we're going to get good yields, and you can estimate or put your own projections on whether you get another ad hoc federal payment. But again, that is what those projections would look like with those items built in. Given that, here's what incomes would look like, or what our projections of incomes would look like. Dale?
So this graph shows grain farm net incomes from the Illinois Farm Business Farm Management Association on their pure grain farms, going back to early the mid 1990s, it looks like. And so you can see again, this is accrual net farm income. So this would be your farm income, gross farm income, grain sales, government payments, crop insurance payments, if there were any for certain years, less all your farm operating expenses, your crop inputs, machinery depreciation, interest expense, and so forth, subtracted off. And this would be based on an accrual accounting standpoint. But you can see, again, we talk about the 2006 through 2012, 13 years being kind of the run up in grain prices and good yields, except for 1 year there in 2009. And then dropping back down. Now, we've been kind of moving up a little bit in the last 3 or 4 years, still below those higher income levels, and up and down. 2018, we had significant MFP payments on soybeans. That resulted in the 2018 farm incomes being higher. The 19 figure was about $75,000. That would be the last year we had actual figures on, of course, would be that 2019 year. So based on what we've been putting together here and kind of shown for 2020 in terms of yield and prices and ad hoc federal payments, we're kind of estimating a good farm income up into the $180,000 range. Again, at this point in time, this is simply an estimate based on those factors that we talked about. but we are seeing improvements from the previous year. And if this does come to fruition, that 180,000 or so farm figure would be the higher income than we've had in the last 5 or 6 years from that standpoint, maybe even a little longer than that. So time will tell whether that comes to pass in terms of that figure. But again, going back to what we thought of a half a year ago, this would be higher than what we would have expected, with a combination of increased grain prices due to strong exports, little blip in supply, and then the ad hoc federal farm program payments playing a significant part in this. And one thing we're not even bringing in yet on some farms are the PPP loan forgiveness. Again, from an accounting standpoint, you can probably handle that in different ways, but if those loans are forgiven, that would be farm income. You could classify it as farm income and adding to this figure if that was the case for some of those farms that did take that. There's other tax issues that need to be handled in terms of how you handle those tax-wise, but just from a revenue or from a farm income standpoint, that could be a plus for some farms also. So again, seeing some improvements on farm incomes, good yields, increase in prices, and ad hoc federal farm program payments kicking in here, boosting farm income. So a better picture than what we would have painted a while back.
We had a couple questions here. What our grain farm income would be roughly 15 to 1,600 acres of size. They would have about 15% of that owned, and about the rest of it would be obviously rented, with a shade more of that share rented than cash rented across the state, and that will vary. Which the proportion of that share and cash rented will vary across the state. Just to give you a feel, this 2015 number would be what we would be projecting with base trend yields and the prices that we're looking at right now. This 73,000 would be with above trend yields and no ad hoc federal payment. And if we got some federal ad hoc payments of $25, we would be in this $100,000 range. So you can see, which is probably pretty typical for this time of year, we could see pretty wide ranging incomes for 2021. And again, it all depends on how optimistic or pessimistic you are on yields and prices. So
again, just pointing out this figure, this is farm income. It does not have family living expense taken out. It does not have income and Social Security taxes that a farmer would pay taken out. So those draws would need to be coming out of this figure. And, you might want to figure 100,000 or something like that to cover family living and income and Social Security taxes, roughly. It varies a lot, obviously, on farm families, but and then you'd have any off-farm income coming in to support that also. What are some of the hiccups that could change this as we look ahead in terms of risks moving forward? Obviously, grain prices, we've seen an unexpected significant increase in both corn and soybean prices the last 3 or 4 months, kind of led by exports, strong exports market, and some hiccup in our production in certain areas of the Midwest. We've had strong soybean and corn yields the last number of years. Generally speaking, if we do have some areas where we have get weather patterns change, drier weather, something like that, and have a drop in yields, so that obviously is going to have an effect. Probably the biggest thing as we look at from 2020 to 2021 is, will there be any kind of ad hoc federal aid programs for next year? That's we're going to have a change in administration, maybe a change in philosophy and some of those things, we don't know. But that obviously has been a big factor in farm incomes the last couple of years. Corn and soybean supplies, if we do have continued strong yields, will we continue to have a buildup in supplies that would suppress prices a little bit? Hard to see much increase in domestic use of maybe corn and soybeans, and that kind of gets down to the last bullet point there, hello China. Again, that's been a big factor. We've always talked about China the last number of years in terms of soybean imports or exports to China, but they've also been the market on corn here recently too. That's supported both of those. So, we obviously in agriculture you'll have all those type of risks, and that's the same thing to kind of lay out here. Do you have one of the webinars coming up here is the farm program and crop insurance decisions for 2021. Farmers will have to make a decision for the farm program. When we started this past winter, signed up for 19 and 20. So now we'll be looking at 2021, where we'll have to sign up again and make a decision on which type of farm program. And I believe there's also maybe a additional new type of some crop insurance products that might be available. So those will be addressed at this upcoming webinar to help mitigate some of the potential risks that we have in farming.
One of the things that we've continued to see since 2013, at least and this is we're showing this for high productivity farmland in central Illinois, 2020 to 2021, heart of the Corn Belt. Prior to 2013, corn, and this just shows the advantage of corn over soybeans. So this would be operator and land return, or even farmer return for corn minus farmer return for soybeans. If it's above this line, corn has been more profitable than soybeans. And we have seen that since prior to 2013, corn was usually more profitable than soybeans. After the ethanol build came, and we plateaued on corn use in ethanol, and we continued to see strong export growth for soybeans. We've seen soybeans returns being larger than corn returns, and that has been pretty much the case since 2013. This 2018 case we're way down here, and that a lot of that is a result of the MFP payments that occurred that year. Again, $3 in 2019, $29 in 2020. We were relatively close the past 2 years, and our projections would say that we're looking at a minus $72 return in 2021. Again, those are preliminary, but the economics, at least for central Illinois, and again, this is a prime corn growing area. You would expect this area to have an advantage in corn because our yields for corn typically are relatively higher than soybeans. In this part of the world, you can see soybeans have been more profitable than corn. That raises the question: will we continue to see movements to more soybean acres? Again, what we've seen is a continued growth in soybeans, and maybe soybeans are back on track for continued exports to China and back to those levels. Does that cause us to think we're growing more soybeans than corn? Which here we're just showing corn relative to the soybean acres, and as you can see in northern Illinois, this northwest corner, we have more corn acres than soybeans. Here in this part of the state, our central part of the state, we see more or about equal corn and soybeans, and then in southern Illinois, more soybean acres than corn. Again, over time, we've seen a shift to more soybean acres since 2013, and again, will we continue to see that shift? And then one can ask: has COVID-19 really altered ethanol demand permanently lower because of the fuel use issue? Again, if we're looking at those ratios vary across Illinois, where we just took a look at northerns and divided the central part of the state in two regions. 60% of the acres in the northern part of the state are in corn, 39% soybeans, and 1% are in wheat. You move south, you get more soybeans, less corn, and more wheat, and that just gives you a feel for that. Again, we're looking at projections for more profitable soybeans, and is it again time to move to more soybeans? And does that require us to think more about soybeans after soybeans.
So we'll move ahead here and talk a little bit about cash rents. And I think, Gary, the next slide, you might have a poll question up there if you want to take care of that.
Yeah, so we're going to do our poll question. We have a poll question, and we had a question. Now, one of our good friends that thinks we were conservative for 2021 with cash rents. What do you think cash rents are going to look like? Actually, we're asking for it in 2022. So we'll see what you think they look like. I guess again we built in the same projection for 2021 as we saw in 2020. We did that primarily because we thought much of the cash rents would have been set by now. Let me pull this poll up here, close this poll, and I'll show you the results. What you think is that they'll increase some 45%, about half, roughly half and half, increase some and remain the same. So that's what you think, and we'll show you some of the trends here. So Dale?
Gary, can I follow up on the question that was asked about the cash rent, the 275 number you put in? Because the question asked suggested that cash rents look back and try to capture extra things, for instance, the payments from the government. Do you actually see that, and or are most of those now built into the cash rent agreements already?
So I would agree that those payments get built into cash rents, and particular and very directly, usually in a variable cash rent, we see a lot of those arrangements where those government payments are included in the calculation of that cash, that adjustment or the bonus or the additional payment on the cash rent. And Dale can state what he thinks, but if you're looking at, and this just again shows central Illinois, you could do this for other regions as well. Cash rents have been relatively the same. Had not these ad hoc federal payments been in here, we would have likely begun to see these cash rents come down in 2020. Again, for 2021, we're looking at pretty good returns, probably something similar to what we saw in 18, which would say sort of continued movement forward. So Dale, what's your opinion there? So
I think, as you mentioned, if you have a variable cash rent lease, I think with those extra farm program payments can be built into the calculation of the gross returns. If you're paying a percentage of the gross returns, you would need to build that in there. If you've had fixed cash rents, like a lot of them are yet also, sometimes those do lag, and so we may see next year's rent being a little higher than economically what we would base it on, based on just next year's facts as we know them today, because of the higher income in 2020 from the farm program payments. So they do get billed in over time. When they get billed in depend on a fixed rent lease versus a variable cash rent lease, and in that variable cash rent lease, if it has the terms in it to bring in these farm program payments. This slide here goes back to 2000, showing operator and land returns. Again, that's a blend then of corn and soybean acreage, basically, or corn and soybean returns and cash rents on highly productive farmland in central Illinois. So the green bar line is, again, what the average return, operator and land return is. So you've got the figure there, subtract off cash rent, and then you'd have the return to the operator. The red line going through there is kind of an average cash rent figure during that time frame. And you can see in the 14, 15, 16, 17, the operator and land returns have been basically what the cash rent has been, which then would imply there's not been anything left over as far as an operator return. Since 18, 19, and 20, We've had returns high enough to pay the cash rent, if you will, plus have a return to the operator. But again, a big part of that, the main component of that has been these ad hoc federal farm program payments last 2 or 3 years that illustrate that. Looking at 21, we'd be back to kind of an even keel there without any ad hoc federal farm program payments. Again, that's an average cash rent figure. We're using 275. I realize there's still rents higher than that out there, over the $300 range maybe, and there's ones under yet. So that's kind of an average. Each situation is going to be a little different. The next slide shows the returns in the 3I, shows the average cash rents in the 3I states. Again, this is an average over the whole state. So in Illinois, you've got northern, central, and southern together. The average rent's 222. Probably the best thing we can kind of draw off on this is just going back in time when we had the higher incomes, then the movement upwards in cash rents, and basically the last 4 or 5 years, we just had a lot of stability in cash rents, as we've had some downward adjustment in rents right after that high income period. And then we've kind of stabilized more or less, as it shows here in the last 4 years. So we really haven't had a lot of movement necessarily in cash rents. Again, it's going to vary year to year if you have a variable cash rent situation, but on average, that's where we're at. Going to the next slide, Illinois Ag Statistics, National Agricultural Statistical Service, NASS, does do surveys, usually every 2 years, although they did have it in 19 and 20 of average cash rents in the different counties in Illinois. And I believe they need 30 or so responses to publish a figure. You can see the 2020 figures. These were released in, by I believe, August, September, middle August or so. That brownish color, I have a hard time describing that color, but whatever that color is our counties with average rents over $250 per acre. And as you can imagine, generally right through the heart of Illinois is where we have our highest cash rents, generally the most productive, or a higher percentage of productive farmland in those counties. We do have some counties outside that do have some higher rents, DeKalb, Carroll, and northern Illinois, and some in western Illinois that have really good soils, like central Illinois. The one thing in central Illinois, we just probably have a higher percentage of the soils in a county that are very productive. But again, you can kind of see the stability. We had a little movement downward from 2019 to 20, especially in the higher profit cash rent areas. But that gives you a little bit of an idea of what those county averages have been. You can see the Sangamon, Macon areas, probably kind of the higher areas, Piatt and so forth, where we have the higher corn and soybean yields. Gary, I'll turn it back over to you.
So just finishing this up here with the cash rent projections. This is the Illinois Society cash rents, and we had they made a projection for 2021, and as you can see there, they were down a little bit from the 2020 levels. Their rents would typically be higher than what would see for the average cash rents, and simply that would most likely have to do with the desires of the people that use professional rental or professional farm managers. They were projecting those rents down. That projection was made in August at the height of our low prices, and probably when we would have been much lower on income projections, and I would suspect that if we took that survey today, we would be at least the same as in 2021. Just some basics about Illinois leasing. 50% of the farmland in Illinois is leased. We're the highest in the country, and our larger grain farms tend to rent much more. You can see there on the right that this is from FBFM Farms, and here we had a question about what our case farm would look like. Here is the exact breakdown. If we had, for example, a 1,500 acre farm, this would be on average, and if you were in northern Illinois, 19% of it would be owned, 21% would be share rented, 60% cash rented. And as you can see, those percentages vary across the state. And again, over time, we've seen cash rent pick up more than share rent. We'll say this: written leases are best, and it's a good standard practice. October 31 is the date when we see a lot of these leases, or if you don't have a written agreement, that is the date by which you have to notify each other or whether that lease is going to be changed or terminated. And as we look across Illinois, most of them are 1-year leases with the right to change at the beginning of the next year. They're year-to-year leases. They tend to be very long term, though. We don't often see those leases changing hands. Obviously, you do some, but overall stability. Here's some definitions of our lease types: cash rent, share rent, variable cash rent, and custom farming. Those percentages show what professional farm managers do: 40% cash rent, 23% share. Variable cash rent would look something like 19%, share rent with modifications 10%, and then custom farming 6%. What we would see a lot of variable cash rents look like, and we're putting numbers in here, there would be a variable cash rent of $200 per acre or something along that lines, and then you would pay a higher cash rent if crop revenue plus government payments exceed times the rent factor exceed the base cash rent. And those rent factors typically are in the 33% range for corn, 40% for soybeans. Again, you can see those in some cases higher than that. Again, there's a lot of variability out here. We're just giving a very standard one that we see quite a bit of. Yield is be based on what's farmed, and you would take an average of a spot price from Wednesdays, for example, from spring to fall. And here is a calculation of what that payment would look like. Again, we see a lot of we see some variable cash leases. They do have the advantage of adjusting up or down depending on what the return situations look like. With that, we appreciate your time today, and we want to thank our sponsors, Todd, don't we?
We'd like to thank our sponsors, by the way. They include Compeer Financial, the Illinois Soybean Association, Farm Credit, FS Growmark, the Corn Growers, the TIA Center for Farmland Research. That's part of the University of Illinois and the College of ACES. You can find that at farmland.illinois.edu. And of course, the College of Agricultural, Consumer, and Environmental Sciences, along with the Department of ACE, which Gary belongs to, and most of the ag economists belong to. Gary, I don't know whether you had a chance to go through some of the rest of the questions there. I think we got through everything we might want to answer for the day. Is that correct?
I think we tried to answer most of these as we went along, and I'm now trying to now I'm looking at these questions, and if we have any if you have any more questions, please put those in there. One of the things that we've asked are you seeing or projecting that there's a trend to more variable cash rents in the future? My answer to that is we've been projecting that, and frankly, we've not. We've seen some movement towards variable cash rents. It still would be a relatively small part of the whole piece of the pie. More of those variable cash rents tend to be professionally farm managed. Again, we think there's some advantages to having a variable cash rents.
Gary, there was a question there about our cash rent maybe being a little conservative with the additional ad hoc farm program payments, and that would be true. We haven't adjusted that figure. I was just doing some quick math here. If you look at 2019 and 20, what we're showing for MFP and CFAP payments, for the 2 years combined is about $150. Depends on how you want to split it between the 2 years, but on corn anyway. And if you divided that by 2 for 2 years, that'd be $75 a year. If you took, say, 35% of that, you could see another $25 per year for the 2 years. on a higher cash rent payment if you had that built in, on paying some of that as part of your variable lease or paying some of that back to the landlord. So that, those extra ad hoc payments could add to what we were showing as average cash rents in some situations.
One of the questions we had, what are average property taxes in the state? Again, this will vary across the state with higher per acre rates typically in the northern and central part of the state. And in that area, we're looking at something like $50 to $60 per acre. One of the questions, do you have any statistics on farm debt levels over the last 5 years? Yes, we do. And they have edged up. We have seen that edge up, but it's still not all that large. I mean, it hasn't edged up. The trend upward is concerning. We've seen those hit probably lows, and Dale, help me with my memory here. I think the low debt to asset ratio was like 0.21. We saw that move up to 0.23, 0.24 now. And again, it's not on average a large amount, but the trend up is a bit concerning. Again, cash, even though farmland prices represent 15 to 20% of the land base, that asset is still a large part of the asset base on farms, and those farmland assets have been holding steady, and maybe holding steady. Let's just call holding steady over time. You would get concerned with lowering farmland prices, but again, you don't see anything on the horizon that would say that farmland prices are going to come down. Where will the Illini men's basketball team end up in the national polls? I am projecting that they will be number 1. So there you go. The winner. Which of the remaining webinars will discuss the decision of PLC and ARC? That will happen on Tuesday. So look for that on Tuesday so you can see that. Is there a sample cash lease on farmdoc? And yes, there is. And I will make sure that we put that towards the front. So we might even write a farmdoc daily article on that. That would be a good thing to bring up. We need a farmdoc daily article. So Dale is going to write that for Tuesday. Right?
Farmdoc daily. Yeah, for Tuesday, and you'll be busy Tuesday, Gary, along with me. Coppice, right? Tuesday and Friday of next week. Again, these are all at 11 o'clock. You're already signed up. You'll get an email reminder, so you don't have to do too much about that. Farm program and crop insurance decisions for 2021 on Tuesday. Gary, Nick, and Jonathan will be there. And then Jonathan will come back on Friday to talk about what the post-election farm policy outlook might be after 3 years of ad hoc farm payments. So that'll be on the 11th. And then the final in our series comes up on Tuesday, the 15th. On that one, Bruce Sherrick will be here, and he'll talk about farmland values. If you want to see any of these, you can always go to the FarmDoc Daily website, farmdocdaily.illinois.edu. The link is right there on the front of your page, or at least you can see the link. And you look in the archives area. And right now, actually, if you go there and go to the registration page, you'll find them as well. They're linked there during this time. So you'll find today's a little bit later, or could be today or tomorrow. Jim Bolts will get around to that here in just a bit. He's been behind the scenes. Our thanks go to Jim Bolts and Dale Latz and Gary Schnitke for being with us, and you too. We're glad you're here. We hope to see you again next Tuesday at 11 a.m. You have a great weekend. I'm Illinois Extension's Todd Gleason.